The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A technical rebound for the tech trade, pushing the S&P toward a 54th record high. Live from a very cold Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
I'm Alex Steele, and I'm very cold. You stole my 54 thunder there.
I know, but who's counting?
I mean, me. We're almost at 54 level. All right, let's get a check in here on where market stands. So the S&P is sitting at a record. We could very well close at another record high. I wanted to point out sort of the winners and the losers, though, within that rally. Romaine, utilities on the downdraft because we're seeing that rise in yields on the 2-year. But on the updraft, we have S&P consumer discretionary at another record high, as well as retail really takes the spotlight today.
Stocks, but also on tech. And remember, it was the outperformance of the tech stocks at the start and in the middle of the year that had largely faded prior to today. We're talking about a 35% rally through the first 6.5 months or so for the S&P Tech Sector Index. That gave way to a fractional decline in the almost 5 months since. But maybe today's tech rally is the right sizing breakout folks have been looking for, or maybe not.
I think as you look into 2025, it's hard, obviously, to envision another 25% year, 3 in a row. And I think the two reasons for that are probably valuation, A, does look a little extended, and then B, the earnings bogey for 2025 is relatively high for the S&P as well.
Some folks pinning their hopes for an extension of the stock rally by eyeing the $7 billion sitting in money market funds, cash funds paying out 4.5% per annum, or about a fifth of the gains in equity. So the logic is that investors will chase those bigger stock returns by unleashing all this cash on the sidelines. We'll see. Remember, strategists made the same call when money market assets surpassed $4 billion in 2021, $5 billion in 2023, and $6 billion just at the start of this year alone. One other development to keep an eye on today is more idiosyncratic, and it involves that carousel of corporate executive changes over the past 24 hours or so. Intel CEO Pat Gelsinger out. This after the chip maker's turnaround sputtered. Stellantis CEO Carlos Tavares out after failing to halt a sales slide. Supermicro CFO David Wigan on his way out after an accounting probe. And dating at Bumble, saying CFO Anu Subramanian will resign in March. But Alex, at least for right now, we still have our jobs.
Okay, let's not jinx that for a second. I want to go back to what Romaine was talking about with that record rally, but also money market assets. So this is a line that looks at them both. You're looking, the white line is money market fund assets, and then the yellow line is the S&P. And as you can see, really since 2023, they've moved pretty much in tandem with each other. And particularly in the last few months, they've both hit those record highs. And the question is, will those money market funds rotate at all into some riskier asset classes, whether that be corporate credit or the equity market? Torsten Slok says yes. He says $2 billion worth of money market funds belong to risky assets, yet we haven't seen that. If anything, we've seen record flow after record flow into U.S. equity assets. Citi was saying that they saw their largest ever monthly inflow remain in November into U.S. equity ETFs, adding over $120 billion.
And it's a great point here, and it raises the question here, where exactly is that cash coming from? Let's kick things off to the close here on this Monday afternoon with Winnie Cisar. She's Global Head of Strategy over at Creditsights and joining us here in Studio 2. I hope you had a happy Thanksgiving.
I did, thank you.
Let's talk about all that cash on the sidelines. And I think we have to kind of chop this up because Alex points out all these inflows we've been seeing into equities. That's not necessarily coming out of money market accounts, though, which still stand about $7 billion. And at 4.5%, I mean, if you are somewhat risk averse or you want more stability, why wouldn't you just ride that?
Yeah, it's a great question. And right now, cash is generating a lot of cash, right? If we have 7 trillion money market funds earning 4.5% interest every year, then that incremental interest probably needs to go somewhere. You're not just going to continue to build and build your cash stockpiles, especially as we see the S&P 500 hit, a 54 time all-time high yet again this year.
And of course, every equity strategist out there seems to think that if that money were to come out of money market funds, it would go into equities. But isn't there a case to be made that it might come out of money market funds, but might actually just end up in other fixed income assets.
Yeah, absolutely. I don't think it just goes into one thing. Investors want to be diversified. They see treasury yields right now and they look fairly attractive. They see credit yields right now, they look fairly attractive. If they're worried about bond yields rising, hey, maybe we go into leveraged loans or other floating rate products. So I think that rotation out of cash into a wide swath of other asset classes is a perfectly reasonable expectation.
What do you think is actually going to happen? I mean, do you think that the money is going to ignite those animal spirits, or do you think not? And that's actually a risk.
Well, so we have been kind of hammering on the power of cash on the sidelines really since 2022. We thought it would help avert a broad-based recession, and lo and behold, it did. Markets recovered pretty nicely, and we've continued to see that over the course of 23 and all the way through 2024. And a lot of that is predicated on the reality that we haven't seen this broad-based recession. People's fundamental expectations have gotten a lot calmer despite kind of all of the headline noise around geopolitical and the election and all of these different things. So as people start to maybe get a little bit more cautious on the outlook, perhaps some of the expectations for fiscal policy changes that are perceived as positive maybe get watered down a little bit, then that could start to put a little bit of a damper on the amount of cash that's rotating back into riskier asset classes.
So what do I do if I hold corporate credit right now? Do I just hold it and wait for that moment? Can I add at this point?
So what we're recommending in corporate credit is an up in quality strategy. Right now, you're not getting paid a lot to reach down in quality. In the investment grade market, triple Bs are trading pretty tight to single As. So perhaps it makes sense to rotate back into maybe longer duration single As where you're getting paid a little bit more yield for getting out the curve, but you have a little bit more credit protection there.
What's going to be sort of the main thing driving risk appetite in the corporate credit space? I mean, we talk about economic fundamentals that seem at least stable, and you have inflation, I guess. Is it under control? I don't know. Maybe it is. And you also have a relatively decent backdrop when it just comes to corporate earnings and cash flows and things like that.
Yeah, this is a really tricky one because everyone is expecting kind of a continuation of status quo into 2025. But we know we have a new administration. We have a lot going on in the world right now. We have a lot of headlines at the single name level as well. Expecting status quo is probably not a great base case expectation. And also at the same time, we have companies that have seen these very minimal spread volatility months for the past 12 months in 2024 and saying, hey, maybe we can pursue that acquisition. Maybe we could do some share buybacks and have them debt financed.
Well, that's what I'm curious about, particularly for some of the, I guess, weaker corporate names out there. You would think, at least if you assume some of the promises that this new administration has made, if those promises are kept, you would think that would create some openings for some of these companies, whether it is M&A or just refinancing, basically a little bit more flexibility than maybe what they would have had under a different administration.
Yeah, I think that there is definitely a perception that the antitrust environment is going to change pretty significantly. And it probably will, right? We're going to have a bunch of new people in charge who are probably going to be a bit more business friendly. But that doesn't necessarily change the fact that the cost of capital is elevated compared to where we were, that valuation multiples, it's, you know, a little bit gappy between bid ask, what buyers can get and what sellers can get. And then also just the reality of trying to execute in a market that might see a little bit more volatility if the Fed doesn't necessarily do what everyone is expecting, or if inflation comes back. There's just a lot of unknowns, or if tariffs are kind of the new things making headlines like they were in 2018.
You're sounding pretty cautious, but without really sort of doubling down on that, because it's hard to stand in the way of some kind of rally. Am I reading you right?
We are cautious, but it's on a bit of a long-term view. We want to respect that power of the technical.
Right.
We realize there is cash on the sidelines. We would be foolish not to respect that. And we haven't seen enough kind of single name, real deceleration to get us really worried about the outlook for the economy in 2025. But what we can say is in a consolidation wave, you generally see that be detrimental to bondholders because you're using debt to juice equity returns. And in 2026, oftentimes those deals won't look quite as good as they did when they were first launched. And that makes us a little bit cautious on kind of the longer run view.
What's your biggest risk right now as you see it?
I think that the biggest risk right now is everyone is expecting a lot of the positives associated with the Trump agenda. You know, deregulation is positive, absolutely. Cutting taxes further is positive. and maybe looking past some of the potential for the noise associated with some other policies, combined with the fact that valuations are really stretched across a wide swath of asset classes.
All right, great stuff as always. Winnie Cisar, Global Head of Strategy with Creditsights, kicking us off to the close here on the first trading day of the final month of the year. A deeper dive up ahead into the health of the consumer with hours left in Cyber Monday shopping. A discussion on how one of the major stars of the day is managing it. Sarah Rhoads is Vice President of Global Workplace Health and Safety over at Amazon. We'll hear from her in just a bit.
Plus, I know it's the holiday shopping season. It's also still earnings season, believe it or not. I know, right? Zscaler going to report after the bell. We're going to break down results as soon as they hit the tape.
And we're keeping an eye on the President of the United States headed off to Africa with trains at the top of his agenda. Why the Biden camp is hoping railroads will be the key to counter China's influence in the region, even with just a few weeks left in the Oval Office. All that and more coming up in a bit right here on Bloomberg.
We laid out a strategy. We reaffirmed that with our board of directors. And obviously, as we've taken these steps this quarter and restructuring and getting our costs where they need to be, we have the capacity to go on the journey.
That was former CEO of Intel, Pat Gelsinger, on the business turnaround he had planned for the company just weeks ago. And that was until today, when Gelsinger was forced out after the board lost confidence in his strategy to win back market share and narrow that gap with NVIDIA. Joining us now to discuss is Angelo Zino, CFRA Senior Vice President and Technology Equity Analyst. Angelo, I've been talking to a lot of people today that say, you know what, this is a perfect case for private equity. Spin it off. Foundry business, chip business. What do you think is the way forward for Intel?
Yeah, I mean, I think that's the question for the new CEO, right? I mean, you had Pat kind of come in back in early 2021. He kind of set this vision really to kind of, embark on this kind of, catch up on the manufacturing side of things. And I think he's done actually a really good job on that side of things. I mean, it was a real issue that they had for years. He kind of brought in the right people. They really kind of caught up on the manufacturing side of things. The problem is they kind of dropped the ball as far as kind of staying where they needed to be kind of with this AI revolution. And this is no longer a CPU-driven world. It's a world being driven by accelerators. Now, the problem with kind of breaking kind of, the foundry side of things with and the product side of things is foundries is still largely being driven by revenue from Intel's internally driven products business. So, our view was eventually you're going to get a split from these two businesses. The problem is, do you do it now? Do you do it later when they potentially get more external related revenue customers and ramp that business up? We actually think you're kind of more in a wait and see type of mode as far as kind of splitting the businesses off. And right now the focus is really kind of on returning that business to positive free cash flow and kind of executing across the different product lines. Who's on your short list? Who could manage that as CEO? That's a great question. I really don't have a list on my end of things. I do think you kind of need, an industry veteran out there to really take this over. It is going to be an absolutely tall task out there, to be honest with you. It is, I'd say this is a tougher situation going into it now than Gelsinger had going back and entering kind of, the Intel CEO position back in 2021. And at that point, that was a tough task.
And I am curious. So I understand that this was probably a necessary move on the part of Intel, but the time that it would take to find a new CEO that would fit the mold, particularly of some of the things that you just outlined there, is this going to set Intel back even further in terms of the catch-up that it's been trying to do?
Yeah, I mean, I think the question, I think there is a need for speed at this point in time. Now, it all depends, does this take 3, 6 months, 9 to 12 months out there? I think kind of who they hired or who they kind of had or who they have serving as this interim CEO or co-CEO level is really interesting. You've got the CFO and Zino out there, and then you've got MJ on the product side of things, and you get the combination of the two really tells you what they're focusing on, right? It's one, financials, and again, returning that company to positive free cash flow generation, kind of becoming a more nimbler company out there, and then on the product side of things, focusing kind of more on, hopefully ramping up some kind of accelerator-driven products out there. Gaudi was not it. But there is definitely a focus, I think, more on Intel side of things, on the product side of things right now, where they are, absolutely bleeding market share, both on the PC side of things and the data center side of things. And that's the real issue, we think, at Intel right now.
It raises a question, too, though, about the reports that we had earlier this year of Qualcomm's interest in the company. Bloomberg just wrote a report just last week saying that Qualcomm's interest had cooled because of the complexities of trying to do such a deal. With Gelsinger out, who we know was, at least publicly, was opposed to this, does that make the possibility of a tie-up with Qualcomm in some way or another likely?
I think it becomes too difficult of a task, to be honest with you. I mean, the regulatory landscape, I think, is way too difficult out there. Not to mention when you kind of look at the market cap of Qualcomm versus that of Intel. I don't think Qualcomm is the right name if you're looking to kind of absorb Intel, in totality. I don't think Qualcomm's the name to do it. If you were to kind of piecemeal some of this stuff, I can kind of see Qualcomm interested in some of these assets. And I think, getting regulatory approval, I think, becomes a lot more manageable in nature. I think if you're selling this thing outright, the company you've got to look more at it that could potentially do it is a company like Broadcom, which has a history of successfully doing it and actually getting, regulatory approval in other geographic markets out there. But at this point in time, I think it's very, very difficult to find any company out there that's actually able to absorb Intel, fully.
All right, before I let you go, Angelo, stock's down 1%, down 21% since the beginning of August. Is this the worst? Like from here, can we sort of level out and then grind higher, or is there more downside?
Yeah, no, that's a good question. I think, from a valuation perspective, I think this is a name that is bottoming out. You kind of look at where book value is. You look where the stock is trading relative to book value. I think you're right there. So it has kind of been leveling out here over the last couple of months. So I think you are kind of past the worst as far as Intel is concerned. I think at this point in time, what investors do want to see is execution, at least on the cost side of things, on kind of, again, returning to positive free cash flow and improving those metrics over the next couple of quarters. And I think that's something that they can do even with these co-CEOs at the helm. So in my view, I think the worst is behind us as far as Intel is concerned. But there is an opportunity cost with owning Intel here over the next 9 to 12 months, kind of waiting on share appreciation relative to other kind of better semiconductor names in our view. All
right, well, Intel right now, third biggest decliner in the S&P 500 on a year-to-date basis, biggest decliner in the SOX, CFRA's Angelo Zino. We'll catch up with you again soon, I'm sure. A closer look at Intel and a big change at the top of that company. Meanwhile, a lot of folks out there are shopping. Millions of U.S. consumers picking and clicking for the best deals this Cyber Monday. When we come back, we're going to get more analysis on what to expect from the holiday shopping season. That's up next on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we start off today with Fastly. Oppenheimer upgrading the infrastructure software stock to outperform. Analyst Tim Horan expects the influx of new AI applications to drive demand for Fastly's edge compute and security products. The analyst also notes Fastly should benefit from internet volumes and pricing now that one of its main rivals, Edgio, is operating under bankruptcy protection. Those shares having a pretty decent day, up about 15%. Next up, Cloudflare. Premium valuation warranted for premium growth. Those are the words of Morgan Stanley analyst Hamza Fodderwala, who raised his recommendation to overweight. He's seeing all the cards align for a strong 2025, saying security software company Cloudflare can accelerate top-line growth over the next few years, thanks in large part to contributions from AI edge computing. Those shares up 6% on the day. And let's end things where else? On the retail front. Gap lifted to overweight over at JP Morgan. The analyst there, Matthew Boss, caught up with the company's CEO and CFO and says the meeting revealed a, quote, consistent playbook of improved merchandising and marketing across all 4 Gap brands. This further supports his case. The Gap is at an inflection point in sales and margin expansion, and those shares are reacting appropriately, a 7% rally on the day, and those are some of our top calls. And with, well, one of the biggest days for retailers underway, Cyber Monday sales taking over the internet. But even before today, those sales were up. Data from Salesforce says e-commerce sales grew 9% in the U.S. this weekend, up from 6% in 2023. Here to talk a little bit more about those trends, Wendy Liebmann, CEO and Chief Shopper, my favorite title of hers, over at WSL.
I want that title.
I know. I mean, how smart was she to carve out a niche for herself as a chief shopper? All right, Wendy, let's start with it. I mean, we talk about Cyber Monday. I don't know, Wendy. I was getting deals back, I feel like, in October, maybe in September here. Black Friday, Cyber Monday, at this point, is just kind of a concept in our heads, isn't it?
It is exactly a concept in our heads, Romain. It is one of those moments where the media, the marketing, on a positive front, have just defined this and will not let up on this. So it's very much a series of months where, you know, people just go shopping from October, hopefully through the end of the year, with a little hype today, of course. What
do the deals look like? Alex just a few minutes ago was shopping right here live on set, and she found some pretty good percentage off. I don't know. I feel like I haven't found the greatest deals. I mean, kind of in line with what I've seen prior to November.
Yeah, I don't think the deals have been really dramatic, Alex. Hopefully you got a good deal. I'd be really happy for you. You know, they are 20, 30% off. That's pretty consistent. But you've been able to get those deals on lots of things, from technology to beauty to fashion, pretty much up from, you know, early days of November. So just keep an eye on things. May get a little better, but I think this is pretty much what it is for the moment.
Oh, yeah. No, I'm talking like 70 to 80% deals. Then you add on the 15 to 20% cash back from Rakuten, and then like we start to talk about stuff. Wendy, what retailer is doing it right now? Because a lot, like you mentioned Gap earlier, Walmart's also at a 52-week high today, but also Bath and Body Works is doing really well. Anthropologie, Abercrombie and Fitch doing really well today.
Yeah, I mean, you can tell exactly what you just said were all the places that I've been to in the last, you know, couple of weeks, and you can see they're getting it right. You know, Walmart, very aggressive, great deals, matching Amazon on many of the things they're offering. So they've been getting it right. Lots of shoppers in there just because it's the place to save these days, guaranteed. Bath and Body Works, really, their new management over the last year have gotten the organization much more realigned. They've got some great exclusives. They've done, what's her name? Emily in Paris deal. They've done some of those things. They've kept their pricing pretty stable, which has been good in terms of a very high promotional retailer. So shoppers who love Bath and Body Works are into that space again. Gap, as you said, they've really, over this last 6 months with their new management, really put in place that very distinctive play and got the fashion and the marketing right. So that's exciting. Amazon, of course, is being Amazon, which is early to bed and early to rise and, you know, clicking for all the deals that you want, the basics that you need. There's a lot of that going on. So the good people have been good and will be through the holidays. I don't think there's any doubt on that.
Wendy, we appreciate that, and great tease for our next event coming up, so we also appreciate that. Wendy Liebmann, CEO and Chief Shopper at WSL Strategic Retail. Coming up more in the holiday shopping season with Sarah Rhoads, Vice President of Global Workplace Health and Safety at Amazon. This is Bloomberg.
Just about 3:30 p.m. here in a chilly New York City. This is the countdown to the close. I'm Romain Bostick.
And I'm Alex Steele. So taking a look at some of the biggest movers overall in the equity market, it is the retailers. You look at consumer discretionary doing really well. Yes. You know what I noticed, though, while I was shopping, is that the shipping is quite expensive now. And I thought it was just me. And then there was an article on the Bloomberg that talked about how UPS as well as FedEx have increased their shipping rates and adding lots of surcharges.
And I have noticed this, too. I buy a lot of stuff online, and I've noticed, you know, a lot of places feel like in the past, they would include the free shipping, which really wasn't free, but it was kind of baked in there. Now, it's not baked in there at all. They're basically saying, look, you want this week, you're going to pay, you know, $25 to FedEx or X to, you know, UPS or whatever. So, you know, I guess if you want it, you're going to have to pay that premium for it.
But how much of that premium is quite substantial? Barclays had a note out that talked about how UPS implemented the largest year-to-year price increases in about 25 years, and FedEx was looking at 275 basis point cumulative increase, the largest annual increase in 20 years.
Yeah, I mean, they're kind of heavy, though, right? I mean, what else are you going to do? Go to the store?
That was so much work. All right, well, let's get more insight onto all of this and the shopping trends, especially when it comes to shipping, from Sarah Rhoads, Vice President of Global Workplace Health and Safety over at Amazon. Clearly, when I'm a Prime member, I don't have the same issues with Amazon Prime, for example. But how are you guys managing, your freight, your shipping, and all of that right now in the busiest holiday shopping season?
Oh, well, thanks so much for having me today. It's great to be with you. So to answer your question, we prepare, frankly, all year for this holiday season. So we ensure that we have the supply chain and the capacity that we need to handle an increase in orders during this time period. First of all, one of the things that we've done is increase our workforce. So we've hired over 250,000 employees to help with the additional capacity that's needed to handle the demand. And of
250,000?
250,000.
Are those temp workers?
That's an insane number.
It's inclusive of full-time, part-time, seasonal work. Globally, we have over 1 million employees, which is pretty amazing considering when I started in 2011, we had 50,000 employees globally. So we've grown quite a bit over the last several years, and we need to ensure that we have the capacity to handle the demand, as you mentioned. And by the way, I am very proud of the benefits that we do offer our workforce. Our starting wage on average is $22 an hour. The health benefits of an employee starting today are exactly the same as mine, and I've been with the company almost 14 years. And I think about the career development opportunities as well through our career choice programs. So a lot of opportunity there.
When you have to hire that amount of workers for this kind of holiday season, is it warehousing? Is it logistics? Where do they go?
All of the above, but primarily our fulfillment centers, which is where our orders are fulfilled. But we also have a transportation network and a middle mile and a last mile. So think of sort centers. We have an air haul network. We have final mile delivery services. And so any type of operation that is within our facilities, those are the roles that we're hiring to. And of course, we also provide jobs through other independent businesses that deliver on our behalf. So if we include for example, final mile deliveries through our delivery service partners. We have over 4,400 independent businesses that deliver packages for Amazon. And so they, of course, employ hundreds of thousands of drivers across the country.
I don't even want to begin to ask you how you keep track of all these people and manage them. But it gets to a broader question, too, about the role of technology in all this. And we kind of always talk about Amazon as being an e-commerce company, but it's really a logistics company more than anything else. What newer technologies are being deployed this season that maybe you didn't have in years past that's going to make this a little bit easier for you?
Right. Well, I know that you both have heard AI throughout the year this year, and we've incorporated AI not only for our customer experience, but for our employee experience as well. So, for example, if you go to our website for our customers, there's an AI-powered tool that we use now called Rufus. And if a customer has a question about a product or maybe some sizing, or maybe they're just looking for some gift ideas for a loved one, they can type in any question to Rufus, and Rufus will provide a couple of different responses and options for our customers.
So I noticed Rufus the other day for the first time. I was like, who is Rufus and why is he on my screen? But it was
hopefully Rufus was friendly.
But it was somewhat helpful. I was trying to buy something and I needed to figure out some of the electronic stuff. Anyway, I don't want to reveal what I bought. But anyway, the point is when you use those tools as a consumer and you get the feedback, how does those tools then feed back into your side of it, meaning the folks who are fulfilling those orders, shipping them, et cetera? Are those the same tools?
They're different tools. So we have tools that we use within our operations that are a bit different than what our customers see with Rufus. So an example of AI that we use under the roof, especially on the safety side, is our employees from the palm of their hand can input any type of safety suggestion from a smart device. And so it allows for a very quick response if there's anything that we need to address or take on their suggestions. I also think about the technology that we have within our facilities now. We just launched a brand new facility down in Shreveport, Louisiana. It's our most automated site that we've ever launched. It just launched a couple of months ago. And we've incorporated AI, robotics, automation. We have autonomous drives called Proteus that move carts from one point to another full of packages. That uses AI. And I also think about robotic arms that also move packages from one point to another.
I just have to ask you, too, because prior to your current position, you basically helped to build the air cargo business at Amazon. I just want to point out, this is actually, I think it was yesterday or the day before, was the anniversary of when Bezos went on 60 Minutes a few years ago and unveiled these drones that were supposed to deliver everything. And I know those drones don't really exist, not enough commercial capacity here. Are we ever going to see that?
So actually, drones are actually in use out of Phoenix, Arizona.
Oh.
So yes, it's a program. We're continuing to work on that technology. That is separate from our air haul network that consists of Boeing 767s, 737s, but we're continue to iterate on the drone program, and we are excited that we've started deliveries specifically in the Tolleson, Arizona area.
Give me some perspective of when you have a facility that has most robotics and AI, et cetera, versus more a traditional warehouse. What's the time saved, like per package, and how does that translate into actual money?
Well, what I can say is that it's the amount of time that it saves our employees because it just makes their job simpler. So for example, when I first started in 2011, all of my employees that were picking orders walked from one point to another throughout the facility. Now, for the most part, we have robotic drives that deliver the item to the employee, so it cuts out all of that walking, and so you can imagine it also reduces quite a bit of time. And when we speak of time, we also talk about regionalization. That's something new that we've done this year as well from a package delivery perspective. So over 76% of customer orders are now fulfilled within region, which means within a couple hundred miles of the customer, which cuts down on the transit timing and therefore the transit costs, and it reduces the touches, which is also where cost is added. And so we've just become much more sophisticated through the use of tools such as AI and machine learning to help just get smarter with how we've placed more of our common popular products closer to our customers.
So what's on tap for next year? The coolest thing we're going to be talking about in a year from now?
Well, we're going to continue to
Rufus
lean in. Well, we'll continue to lean into robotics because that's still an emerging space for us. We're really excited about the future of robotics and automation, and we look to incorporate some of that technology and retrofit some of our existing sites to the extent that we can. So more to come in that space.
The bigger question is, have you done your holiday shopping already?
I still have some work to do.
Are you allowed to shop anywhere else but Amazon?
Yes.
Okay.
But I will say that we do have some great deals, and Cyber Monday is not over yet.
Fair enough.
Shameless plug.
Sarah Rhoads,
we like it.
Sarah Rhoads, Vice President of Global Workplace Health and Safety at Amazon, reminding you still have a few hours here on Cyber Monday to get your shopping done. When we come back after the break, we continue to count you down to the close, taking a look at some of the big movers on the day, including Supermicro having a super day after a special committee found no evidence of misconduct on the part of management or the board of directors. We're going to break down what's next for this company. That's coming up next in our Stock of the Hour, right here on The Close on Bloomberg. Welcome back. Let's take a look at shares of Supermicro. The shares rallying more than 20% here on the day after the maker of data servers said that a special committee found no evidence of accounting misconduct by management or its board. The company now searching, though, for a new CFO after the review also recommended appointing new financial leadership. Abigail Doolittle joining us right now for more on this story. Of course, this was a stock that just rocketed to the moon and then plummeted back to earth, primarily because it seemed like they weren't really ready for prime time. This is an S&P member, by the way.
It is,
Yeah.
and that was a big piece of the big rally to the upside. From the pandemic low to this year's high, up about 7,000%, more than 7,000%. From this year's high to the low, down 86%. Now up 140% over the last couple of weeks. Talk about volatility, but still down 65% from the highs. Speaking to your point that they grew so fast relative to the AI potential, they just weren't quite ready. Old practices die hard, and this company has an auditing practice or problem from the past.
Yeah.
This is the second time they've had to restate financials. Now, the interesting thing is that CFO was fired for the CFO that was fired today. But the constant is the CEO and the board. So we're speaking to Woo Jin Ho, who's just a wealth of knowledge on this company. And he was saying on the record that he really thinks that the board needs to see some changeover, and that possibly even, the CEO makes some real changes at this company. I mean, one question about this independent review, it was appointed by the board. Yeah. How independent is it?
Right. And I guess the question then becomes, what visibility and when do we have for their actual cash flow and their customers, and have customers actually switch during this very tumultuous time?
That's a great question. So Woo Jin was saying that he believes that they're actually going to have to guide down, that won't happen for a few quarters, but because there are customers who are nervous about all of this, that they've probably gone to your Dells or other places, companies that can offer these servers for the AI chips and other types of chips, so that the numbers will probably have to come down. But I think that right now what we're seeing is just this relief that it's still a going concern, that they seem to be in some sort of a conversation with the NASDAQ to stay listed on that company. And something else, or on that exchange, something else big is the S&P 500 rebalancing. You were speaking about the S&P 500 earlier, Romaine. It happens on Fridays. So the fact that they've made these efforts with the NASDAQ, and now today they have a new CFO, they have BDO on board, it probably is, some people think it's less likely they're going to get kicked out of the S&P.
But that's what I'm curious, is this really going to save them? Because when you look at the standards for entering into the S&P, I mean, they just kind of barely got in there. And now you consider all that's gone on since then. Like, is there any real reason why the S&P would want to keep them there?
It's going to be interesting to see whether or not they stay or not. I mean, the rally right now, it could be shorts getting out. There's a roughly 20% bearish short interest on this stock, so maybe some bears are just not willing to take that risk. And then after Friday, maybe we're going to see, what the direction is in terms of the actual fundamentals.
Right, and sort of just get the worst out that you possibly can, and then try and regroup. All right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us there. Now, what I was struck by, it wasn't Merger Monday today. It was like Management Mayhem Monday, because this was the tip of the iceberg in terms of management changes.
Yeah, so as you mentioned, the CFO of Supermicro, they're going to search for a new CFO. He's still there for now. But, of course, we talked about this. Intel CEO, Pat Gelsinger. I mean, I guess not total surprise, but kind of a surprise.
Well, what also got me was Stellantis and sort of the change in CEO as well. But that stock down 6%. And speaking to some analysts, it did seem like it was a bit of a head scratcher. Like, why now when everyone else is dealing with the same problem when it comes to EVs, for example?
Well, that's what's curious, and it raises the question when you talk about the stock reaction. Who's the replacement, right? You got dual CEOs right now at Intel. I don't know what they have at Stellantis right now, but at some point they've got to find their appropriate leadership. And then you had sort of second-tier companies, like Bumble, also saying that its CFO plans to leave next year.
Yeah, it looks like it's they're still looking for a new CEO when it comes to Stellantis. So it's like they don't even have one yet. It's a dual situation. All right, we're about 15 minutes away from the closing bell. We'll break it down with Jay Woods over at I'm Not Available. I'm here. This is Bloomberg.
What we're recommending in corporate credit is an up in quality strategy. Right now, you're not getting paid a lot to reach down in quality. In the investment grade market, triple Bs are trading pretty tight to single As. So perhaps it makes sense to rotate back into maybe longer duration single As where you're getting paid a little bit more yield for gaining out the curve, but you have a little bit more credit protection there.
Winnie Cisar giving her insights here on some of the best places to invest in the fixed income space. Welcome back to the close as we keep an eye, Alex Seal, on what's going on in the equity markets. Tech stocks back out front again, something we haven't really seen with any consistency for about a month now.
Yeah, the semis really leading. Like you look at the SOX index doing really well, Lam Research, for example, et cetera. But also S&P Retail Select Industry Index, I know it's a mouthful, but that sector up by 1%. I point that out because consumer discretionary yet again within the S&P at a record high, and the S&P itself looks like it's going to close at a record high.
I guess it's sort of fitting given that everyone in theory is out shopping today. And I've seen some of the numbers. I mean, when you look at total numbers for the holiday shopping season, a significant improvement. Obviously, some of that's inflationary, but still definitely an improvement over last year.
Yeah, and it's also not just that, but like Norwegian, for example, it got a price target upgrade over at Truist. So that's Carnival and Norwegian doing really well as well. It's Gap, Bath & Body Works. It's not just the Walmart and Amazon of the world.
Well, that's a very good point. It'll be interesting to see how those names really hold up through the rest of the holiday shopping season. The stock market is holding up. Alex?
54.
Thank you.
You're welcome.
That's why we keep her around. She keeps the official tally. The S&P 500 right now looks like it's headed towards a 54th record high for 2024. Whether that continues into 2025, let's talk to Jay Woods, Chief Global Strategist over at Freedom Capital Markets, joining us here in Studio 2. And there's been a lot of talk about this run-up, how it's defied a lot of expectations. There was a stat that you sort of flagged ahead of time, saying that basically since 1950, the post-World War II era, there's only 9 occasions where the market was up 20% or more heading into the final 2 months of the year.
Yeah, and what happened those times? 8 of those 9 times we were higher, and December was the stronger of the 2 months, up 3.16%. If we're keeping it exact, we can round up to 3.2. But yeah, that strength begets strength, and then if you think about going into December, when you have a strong year like this, back-to-back strong years, best back-to-back since 1998. Where are people going to tax harvest? There's no selling narrative. They're going to chase performance is what they're going to do. And that cash on the sidelines, the retail sector, as Alex just mentioned, we're seeing that catch a bid. The home builders breaking out to new highs, the regional banks. So we're seeing strength in a lot of the smaller issues that have been lagging because people are looking to chase performance. See, what's beaten down? Where do we go? And then those big cap names, if you're not in them, you better join the party by the end of the year so you can tell your customers, yeah, I'm in those names as well.
Well, we have seen that rotation into some of the small and mid-cap names. I was looking at the outperformance of the Russell and the S&P 400 mid-caps relative to those big tech stocks over the last, 3 to 5 months or so, and it's meaningful.
Rotation is the theme of 2024. The theme of 2023, 7 stocks. The tip was higher. Now, you look at the 11 S&P Spider Select indexes. The worst performing is up 9.5%. That's healthcare. It was up a lot more before RFK was named, but we had them up all over 10%. And technology is in the middle of the pack. And Alex mentioned technology, semiconductors are leading. Well, semiconductors were lagging. We saw strength in technology, but it was cyber. And it was the cybersecurity and software, IGV, both making new highs. So we're seeing rotation not just from sector to sector, but within the sectors. So when you see that NVIDIA is coming back and the semis are coming back, this is fantastic. And this is setting us up to catapult again to start off 2025 in with all the right places in place to keep us going.
How do I trust it? Why do I trust it?
Why do you trust it? Well, I like to trust history, and history's been a good guide. It doesn't always follow suit. We don't know what X factor is going to come into play. But, a lot of people like to put the president's name on this. 2017, first year of a Trump presidency, the most boring bull market we've ever sat through. The S&P was up just under 20%, 19.7%. And we didn't have a drawdown of more than 2% in any day, despite crazy headlines. And we saw a lot of sectors continue to slowly go up. So I think the theme is there. Do I think it's going to continue as strong as, say, 2017? No. But I think we will have a good first half of this year. And I'm bullish that we're going to have Dow 50,000 hats by the end of Q1 of next year.
All right, make my hat, and then you can come back.
Done and done.
Yeah, totally.
All right.
Do you think the money, though, that's going to flow into to the market is going to come from like money markets, or it's going to rotate within the market?
Well, we're seeing rotation, so I think it's going to continue to rotate, and then you're going to have people. I hear this, term that I don't know how to justify all this cash on the sidelines, $6 trillion worth of cash on the sidelines. But there are people that are looking at the American markets and saying this is the place you have to be. Then you think about the sentiment. The sentiment isn't that bullish. There are people that voted in this election thinking the market was down, thinking that, the economy's terrible. The economy is not the stock market. And people are realizing there are gains in the stock market. And what we're seeing now, and this has me a little concerned, some of those beaten down names are catching bids. ARK is taking off. You look at Zoom, you look at Peloton coming back, DocuSign. I looked at AMC today, and after Moana was breaking records, technically the risk-reward setup is favorable to the bulls. I wouldn't recommend jumping into the name, but the downside risk versus the upside reward is there, and people are looking at things like this, and they're taking shots. And to me, that's extremely bullish. Not euphoric yet. We'll talk about IPOs if that starts to happen. But to me, I think we're poised to go higher from here.
In conversation with Jay Woods over at Freedom Capital Markets, some breaking news crossing the Bloomberg terminal right now. This on Cargill. This is, of course, a big food and grain company, cutting thousands of jobs globally after its profits shrink about 5% of its workforce, of its 164,000 workforce. About 5% of those jobs will be eliminated, according to an internal memo seen by Bloomberg. And Jay, I do want to pose this question to you. I mean, we talk about the health of the economy and corporate fundamentals. And I know sometimes moves like this, 5% trim in the workforce at the end of the year. A lot of times that's about right-sizing things and preparing yourself for 2025. But do you have any economic concerns heading into next year that could affect corporate fundamentals?
No, what we're seeing right now are those that are continuing to power up. You look at what Walmart is doing, up over 60% year to date, one of the best years ever, at least going back to the 90s for Walmart, and Target's lagging. I'm watching stores like Dollar Tree and Dollar General, which report later this week. Will they catch up? Or is it just a question of people are rewarding those that have the performance, which just happen to be some of the biggest stocks out there, or is there a trend? The consumer is still spending. I was at the mall this weekend, Black Friday. I don't know if this works, but it does. Okay.
So you were shopping for yourself?
I was shopping. Well, Cyber Monday
not
later. I have to finish work first. But no, the malls were packed. The consumers out there spending.
Yeah.
There is a confidence. We're seeing earnings growth continue. So to me, fundamentally, it's still positive. But when everyone gets a little too positive, then I'll pull back the horns a little bit, and we'll talk about sectors that you have to take some profits in.
All right, Jay, we got to leave it there. Jay Woods in a very nice, snazzy new jacket, Chief Global Strategist over at Freedom Capital Markets, helping us count you down to the closing bells here on this Monday afternoon, first trading day of the final trading month of the year, with the S&P 500 nursing a record high. A full breakdown of all your market coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through the closing bell, a global simulcast. It starts right now. Scarlet Fu wheeled into the TV studio. Carol Masser and Tim Stenovic
what does that mean,
in their radio booth. We have wheels on our chair.
Injured?
And they just wheel her in. Yeah, it's great.
Okay?
It's beautiful.
Are there medics involved? Like, what do we need to know?
No medics involved. She's alive and well and healthy as we break down all of the crucial market movements of the day. Carol Masser.
Yes.
You were already talking, so keep talking.
I will keep talking. I've been looking at the semi-space. I think
Happy Thanksgiving, by the way.
Happy Thanksgiving, guys. Mwah. Hope you had lots of pie and good stuff. I've been looking at the semi-space. The Philadelphia Stock Exchange Semiconductor Index, you're looking at about a 2.6% gain. Almost 29 of the 30 names are higher. And I thought it was interesting in a day where out of the Biden administration, they're proposing kind of more rules, restrictions when it comes to selling AI and chip-related companies to China. And what our analysis seems to say is that maybe it wasn't as bad as everybody expected. And so Lam Research, ASML, KLA, you've just seen many of these names higher.
You guys are talking about public markets, public companies. We saw the news just moments ago that Cargill is set to cut thousands of jobs globally after the largest privately held company in the U.S. missed its profit targets. Alex, you know this, they're the world's largest ag commodities trader, cutting 5% of jobs. They kind of play in everything. And I'm wondering, what kind of bellwether this is.
We also saw Tyson, Scarlett, also cutting about 850 jobs as well.
So you wonder how this will all fold into how the Federal Reserve and Fed officials specifically talk about the economy. Chris Waller spoke this afternoon, and he sounded kind of dovish.
Yeah, and we talk about those layoffs here. I just want to point out, Tyson, they've been laying off a lot of people for the last year or so. I think going back to last year, in early 2023, they've shut down at least 6 different plants here. So some issues there in the food sector as we get the closing bells here in New York. The Dow Jones Industrial Average sitting this one out, down more than 100 points or 0.3%. The S&P 500, 6,047 and change, up 0.2% to a record high. The NASDAQ Composite and NASDAQ 100 each closing out the day at a record high. And the Russell 2000, we'll just call it unchanged on the day, right on the screen, but only fractionally, less than 0.1%.
All right, back to the big caps I go. The S&P 500, guys. Most names lower today, 180 to the upside. Scarlett, you had 320 names losing ground today, 3 unchanged.
Yeah, and that's reflected in the sector performances, too. Let's look at the IMAP. You have 8 sectors in the red. Utilities, the worst performers, down more than 2%. 29 out of 30 names lower, or I should say 30 out of 31 names lower. Real estate investment trusts and financials also losing ground, too. But your winners, the strong parts of the market, communication services, consumer discretionary, and info tech, and of course, those 3 sectors house a lot of those big tech names.
Yeah, we've seen that before, right? Like lifting up the overall market. All right, to the individual gainers we go. Supermicro atop that list. It is your top gainer in both the S&P 500 and the NASDAQ 100, guys. It's up 28% off its highs of the day. At its peak was up 35%, but still almost a 29% gain here on the Monday close. We know it's been a tumultuous year for Supermicro. Today, a bit of a bullish day, to say the least. The company came out, said an independent review of its business found no evidence of misconduct, but recommended that the server maker appoint new top financial and legal leadership. So, again, the cycle goes on this one, but this was an update certainly for this one. Lam Research, as I mentioned, most of the names in the stocks were up today, and that included Lam Research, which is your second best name in both the S&P 500 and the NASDAQ 100. 500, up about 6.25% here. What's interesting is, again, that thinking that these new rules and restrictions on some of the semi sales to China in particular would hurt this group. But again, the analysis seems to be that it wasn't as bad as it could have been. And so you saw this name and this group overall rally. And then one more, Tesla up about 3.5% in today's session. You had at least two analysts upgrading the stock to buy from hold. That was Roth MKM. Stifel raising its price target to a street high. So they've got they raised it to 411 from 287. Stock closing at 357 and change. So anyway, they talk about investing in Tesla requires vision, patience, a willingness to accept volatility. But like I said, at least two names being pretty bullish on this one. So a good day for Tesla, at least if you're a bull.
Tesla had a really good month in November.
Yeah, there's that too.
By the way. Hey, some of the decliners today on my radar include Intel. I stole this one from Carol. It was higher for much of the session, but did end up closing lower. You guys know this already. Intel CEO Pat Gelsinger forced out. The board lost confidence in his plans to turn around the company. It's just turmoil at one of the pioneers in the tech industry. The clash really came to a head last week. Gelsinger apparently met with the board about the company's progress on getting back market share and narrowing the gap with NVIDIA. That's according to people familiar with the matter. He was given the choice to retire or be removed. He chose to announce the end of his career at NVIDIA, said the people who asked not to be identified because the proceedings weren't made public. This thanks to our team out at Bloomberg News. Shares down by about 0.5% on the day today. Stellantis, another shakeup in the C-suite. Carlos Tavares out. At Stellantis, it is the parent company of Jeep and Peugeot, among other companies. It's a surprise departure. And now Stellantis is without clear leadership. It's under pressure to halt a sales slide in the U.S., tackle those overcapacities in Europe, and then also demand for EVs waning just as Chinese automakers are expanding in the region. The company did appoint executives, including the boss of the North America division, to take over from Tavares as the automaker works to fill that leadership void. And finally,
how are they going to do that? I mean, don't they have? Yeah. I mean, what's the easier turnaround, Intel or a company like Stellantis?
I think Stellantis. What do you guys think?
Really?
Yeah, I do. What did you? Because we talked to Gabby Coppola about this, and she said they're already. One of the big issues was killing off the less expensive models of the Jeep that were super popular.
Yeah.
And, really going at the premium end of the SUV category. It turned out, that a lot of Americans can't afford cars at that end of the spectrum. And they're already announced some cheaper prices for 2025, Gabby said. So they're trying to go back to the lower end of the consumer. I don't know. Intel's a tough slog. I don't know. Yeah. What do you guys think?
And they're both in structural issues, right?
Yeah.
One is the AI chips and the competitive landscape with NVIDIA, and the other is EVs and then how fast you transition. So they're both in these different structural changes within the market, which is quite interesting.
And then there's Boeing.
Maybe they should just
right?
switch places.
Sure.
Yes.
Intel can make cars.
I'm just saying. Who knows?
Hey, one more. There is one more. Oh, though you have earnings, Romaine. We still have earnings?
Yeah, we have earnings. Let's get right to it. Zscaler. So we'll stay in the tech space here. Their adjusted revenue in the fiscal first quarter coming in above estimates, 70 cents a share. The street was looking for 64 cents a share. Sales at 628 million. The street was looking for 606. The guidance for the fiscal second quarter, though, causing some concern. A range on the revenue side of 633 to 635 million. The bottom end of that range is right about where the average of analyst estimates are. And as far as EPS, a range of 68 cents to 69 cents, the top end of that range below the average of estimates of 70 cents a share for the quarter. The shares, you see, moving lower by roughly about 3%.
All right, jumping into the press release, looking for commentary. Jay Chowdhury, the chairman and CEO over at Zscaler, says that they have growing customer engagement, strong sales execution, driving a solid first quarter, all metrics exceeding our guidance. The combination of zero trust and AI creating exciting new opportunities when we are well positioned to capture with our large and expanding platform, with our customer obsession, the world's largest cybersecurity cloud and an up-leveled go-to-market machine. We are driving strong growth. Shares down in the after hours by 5.3%.
All right, I just want to highlight here what's happening in the bond market and just to circle back and sort of wrap up our market check of the day, because there was a lot of action in the bond market, particularly in the front end. Yields ended higher by about 3 basis points. We sort of trimmed, though, that move higher by Governor Chris Waller, commenting that he's leaning towards a December rate cut, absent a data surprise, and he says that rates still have some distance from their neutral levels, so sort of setting that stage for more cuts to come, guys.
All right, so let's get to some of the stories that caught our attention on this Monday, and this is for Romaine and Tim. In case you were wondering what to get me, Scarlett, And Alex, turns out diamonds are on sale right now. Not exactly buy one, get one free, but De Beers has apparently cut diamond prices by more than 10% across the board. They are the world's biggest producer. They've basically said, I'm in, I'm out. We're not going to try and put a floor under the slumping market. I mean, it's been a rough market.
I'm actually very intrigued by this. I mean, not so much for the 10%, but just the idea that we kind of know that the big diamond companies have always found a way to keep prices elevated and the pressure. I mean, we've seen so many stories about what's going on in some of these diamond producing nations. I mean, there just is no support right now for where prices have been.
But the lab-grown diamonds also hurt the this market too. That's the other thing, right? Gen Z is really into the lab-grown diamonds.
So post-pandemic slowdown, inflation, collapse in China's luxury market, and then you have the lab-grown diamonds. And Carol said she saw some recently.
I went into a jewelry store. I had something fixed. There's regular diamonds, lab diamonds, and then there's like something above CZ's. Like there's all these choices.
Yeah. What'd you get us then?
All I know is don't you two dare buy us CZ's.
Well, you wouldn't know the difference, apparently.
Oh, yeah, you just put it in your mouth and you bite.
I was just going to go down to Canal Street and get you your gift.
All right, that's a wrap, guys. That'll do it for our Monday simulcast, radio, TV, YouTube, Bloomberg Originals. We do it all. We call it the closing bell. We will see you again, same time, same place tomorrow.
Our coverage continues right here on Bloomberg Television. A deeper dive up ahead into some of the major headlines coming out of the broad tech space. Dan Newman, the CEO of the Futurum Group, he'll be joining the close in just a second. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Foe.
And I'm Romaine Bostic. Let's take a look at how markets ended the day. They ended the day, well, where else? At a record high, 54th record high for the S&P 500. But it was not led by that broad-based rally that had been the hallmark for the past few weeks. The big gainers on the day, well, that was in the chip space, in the tech space. The Mag 7 higher on the day. The Philadelphia Semiconductor Index higher on the day, 2.6%. And tech stocks overall leading the charge. The dollar also getting a bid for yet another day, something to keep an eye on as we head into 2025, and how the dollar strength ends up affecting some of the corporate fundamentals. And keep an eye on China. You're looking at 1992 on one of their benchmark yields. That may not seem like much to you, but that is below the psychological barrier of 2%, a barrier that it hadn't broken in years.
Well, Romaine, you mentioned the strength that we saw in tech shares. Let's focus in on a couple of movers in the tech space. Zscaler down right now in after-hours trading. We'll get to that momentarily when it comes to the latest results. But I do want to highlight Intel, for instance. Intel rose as much as 6% before turning negative and then ending down. This, of course, as the CEO, Pat Gelsinger, was forced out after the board lost confidence in his turnaround plan. I also want to mention Supermicro, the best performer in the S&P 500. It said an independent review found that there was no evidence of misconduct, but did recommend a new CFO and new legal leadership as well. All right, let's move on to our top story this hour. Shop till you drop, especially when there's a deal or some kind of value, added value at hand. Cyber weekend e-commerce sales rose 9% this year. That's according to Salesforce data, and that marks a pickup from the 6% pace in 2023. The average discount, however, was 28%. That's down 2% from last year. Later in the program, we're going to be speaking with the CEO of mall operator Tanger about what kind of foot traffic his properties are seeing. Romaine?
All right, as we keep an eye on shares of Zscaler under pressure after the security software company reported its most recent earnings here. It looked like on some of the metrics it did miss, though on the guidance level, there were a few things maybe that could sort of prove to be bright spots. Mandeep Singh over at Bloomberg Intelligence joins us right now here in Studio 2. And I mean, this is a company, I'm not sure what's ailing it, if this is specific to Zscaler or there's something broader going on in the cybersecurity space.
So what we have seen this earnings season is the AI kind of theme impacting the infrastructure names. And we saw that, the beat from Snowflake, Datadog. In this case, clearly they had a beat this quarter, but when you look at the guidance, they're not talking about, going past cloud optimizations, which is what ailed, the cloud infrastructure names for the past few quarters. So the fact that they haven't really raised guidance, I mean, this was the type of quarter where every cloud infrastructure name that did well beat and raise. And so that's why you're seeing this sort of disappointment.
Yeah, no beat and raise means that you're going to sell off the stock.
Yeah.
Competition is a concern here for Zscaler. And I know that it's been restructuring its sales force, and so that could be kind of a temporary short-term pain as well. What is its competitive advantage at this point?
I mean, look, in the cybersecurity space, it's all fragmented. No company has more than 10 billion in revenue, and Zscaler is that type of company which is a single product trying to expand into new areas, but there are, an acquisition target themselves. Even though they have done some tuck-ins, you could argue, a company of that size with 30 billion market cap is perfect if the regulatory environment was to ease, and you could see them as a potential target. And I think that's been the cybersecurity playbook over the years, that companies do end up getting bought out.
Well, I am wondering why we haven't, though, seen a little bit more activity in the space. And I think we've had you on several times this year, in 2024. And I think I've asked you this question as to why we're not seeing a little bit more consolidation in this space. Is now kind of the time? Is it ripe for it?
We have a new administration that's supposed to ease up, M&A. And so we should see bigger deals. All these companies have done tuck-in deals themselves, but when it comes to bigger M&A, and this would be like a $35-40 billion acquisition going by the current market cap. So a company like Broadcom that did buy VMware would, I think, want to add someone like Zscaler because it complements their security business really well. So those are the type of deals we haven't seen, but if I think the new administration was to go easy on deals, I think this could be a probable target.
All right, well, that's the betting so far. Mandeep Singh, really appreciate it. Mandeep Singh of Bloomberg Intelligence. Now, for more on the broader tech space, let's go to Daniel Newman. He is the CEO of the Futurum Group, and he joins us now. Daniel, you heard what Mandeep was saying about, all this optimism that the new administration will be more lenient with consolidation and how Zscaler might be some kind of acquisition target. I guess the same question could be extended to bigger tech companies like an Intel, especially now that the CEO, Pat Gelsinger, is out and they're in a search for a new CEO and, honestly, a new strategy.
Yeah, today was really surprising. I think anyone that kind of looked at everything that happened would be able to look and say, this wasn't planned, at least not for a long period of time. This was a situation that came to a head and a big decision was made. As it pertains to the M&A situation, I certainly do believe under the Trump administration there will be more flexibility. The amount of scrutiny that each deal is going to be under will probably be lower, and the desire to see more combinations will happen. That's also a product of the economy. The economy is looking stronger. The tech trade has continued to accelerate, and despite what you just saw with Zscaler, overall this last quarter was pretty good. There were a number of beats, raises, and there still seems to be a lot of optimism around AI. So I feel positive that these M&A deals could continue to bubble up, and security is definitely an area where we could see some of these deals start to come to fruition.
What is the best path forward here for Intel as it tries to reassess and kind of course correct right now?
Yeah, I've been able to spend a lot of time with Pat over the last few years, and I've also gotten to know MJ well, as well as David. And look, the situation was pretty straightforward. It was either going to split off, look at what they've done with Mobileye and Altera, or it was going to try to keep going together. Pat was adamant about continuing to go together, but I think overwhelmingly, and this started with Lip-Bu Tan leaving the board, there was a feeling that the separation was going to be necessary. And this all comes down to the ability to win over the NVIDIAs, Qualcomms, AMDs, these large volume producers, these fabulous designers. And there just seemed to be a little bit of consternation, a little bit of hesitancy as to whether it's chip policy that from the CHIPS Act that these companies were ever going to fully trust to build with Intel. So this is the moment. Clearly, Pat said, if this is the way you're going to go without me. It's going to be very interesting. But I do think the split could provide a warmer environment for these fabulous designers to lean into Intel and build more chips in the U.S.
I do have to ask you, Dan, about the foundry business. There was a lot of talk that this could potentially be kind of the next chapter for this company. There was obviously a lot of talk about the government financing and the idea that they were being given potentially a lifeline as the U.S. government sought more ways to try to onshore chip manufacturing.
Well, you can look at this two ways, Romain. I mean, first of all, the U.S. needs to manufacture more semiconductors. We should all want a champion in the U.S. here that can make more leading-edge semiconductors. TSMC is very successful, but of course, TSMC is a Taiwanese company. We have a great relationship, but there's all kinds of complexities as it relates to China. it's uncertain. And we know that whether it's data center servers from NVIDIA or iPhones from Apple, we need to be able to manufacture more of them. In the US, Intel is the best bet. So the US is backing Intel for its foundry business, but it's also backing TSMC. It's backing Samsung, Micron, and everyone else. So we are trying to diversify here in the US and trying to have more optionality for manufacturing these leading edge chips. But realistically, we need Intel to succeed. We need this next node, they call it 18A and 14A, these leading edge nodes to succeed. And we need our biggest and most innovative chip designers like NVIDIA to start using Intel in some capacity.
Yeah, I bring this up too, and we have some breaking news, Dan, that I just want to read to our viewers. And this is involving microchip technologies, which makes a lot of microcontrollers and other sort of components that go into sort of the broader tech and chip space. A revision of their earnings forecast down. But more importantly, they're pinning this on high inventory levels. And they talk a lot about how some of these inventory levels aren't necessarily right-sizing themselves and that they will effectively shut down their Tempe, Arizona wafer fabrication facility. That's going to affect about 500 employees. And of course, the company lowering its forecast guidance for the year. And Dan, I know you haven't a chance to parse this news, but it raises a lot of questions as to whether this big inflection that we're looking for out of an Intel, and for that matter, out of some of the other chip makers, particularly when it comes to doing more stuff here in the U.S., whether that's an opportunity that we've missed. Have we just sort of gotten too far in this cycle to make this work right now?
Well, what I think is we have to stop thinking about this AI trade or this AI market as being late. Now, there is a difference between all different types of chips. Not all are created equal. This AI wave has really carried the whole semiconductor average, the whole index. And of course, different older, lagging, and essential nodes, those have performed differently. We've seen areas like communications and industrial and IoT have slowed meaningfully while AI has continued to accelerate. So companies in that space could be at more risk. What I would say is we haven't missed any opportunity. And I think it's a little bit short-sighted for us to even think about slowing down here. Now, there's a lot of complexity. You can't build boundaries in weeks and months. This is a multi-year investment. But at the same time, knowing what's going on in China, knowing what's going on with our policymakers here, the potential of tariffs, we want to make more here. We need to make more here. AI is the frontier in which the world's economy will be won. And we need to be very focused that we have at least a share of the manufacturing being done here, which right now we have almost none of the leading edge.
Okay, so phase one of the AI excitement was definitely on the chips, and it feels like we've moved past that. We're being a lot more discerning now. A lot of people say phase two is the software companies, but what is the best metric to determine who is wringing the most value out of that? Is it going to be the ROI from the CapEx that they put into generative AI? How are you thinking through that?
Yeah, Scarlett, if I'm an investor, a lot of people are probably looking at the NVIDIAs and going, am I too late? And then they're looking at potentially maybe a Micron for that, high bandwidth memory and saying, is there still going to be this kind of demand, which I expect, or you're looking at TSMC. I'm sort of looking down the pipe a little bit further. First of all, these cloud providers, I expect this week, I'm here in Las Vegas, it's at the AWS event. I expect Amazon to be making some meaningful announcements around not only its silicon, but its entire AI stack. And this is something to watch for. We know that Amy Hood at Microsoft has been one of the few that have really put numbers forward as to how much AI is impacting their business, but they're spending 60 to 80 billion to drive 10. So that number, that metric, those mathematics are going to have to change for some people to feel ready to invest. Just really quickly, I also really like, what they're doing at ServiceNow. I've spent time with Bill McDermott. I've spent time with Mark Benioff at Salesforce. Very interesting there as well with agents. All
right, Dan, we got to leave it there. Great stuff. We'll catch up with you again soon, I'm sure. Dan Newman, CEO over at the Futurum Group, coming up. The top three right after the break. This is The Close on Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Jeff Bezos, investing $700 million in an AI chip startup that hopes to one day challenge NVIDIA. The startup is called TensTorrent and is valued at about $2.6 billion.
Yeah, I mean, I guess this isn't surprising given some of the ambitions that his company, that of course is no longer helms, but this company and where it's going, and obviously him trying to put some of his money, I guess, where he thinks the puck is going. Another, tech founder that I'm also keeping an eye on is Reed Hastings, of course, the founder of Netflix and the former CEO there, applying the management techniques that he used at Netflix to his latest venture, which is a Utah ski resort. Hastings bought a controlling stake in Powder Mountain last year. There's been a lot talked about it, and I think some of the same ruthless efficiency, if you will, that he has sort of applied to the early days of Netflix, he's now trying to apply it there.
Yeah, he's using a subscription model. It's seasonal, and he's basically portioning off part of the mountain just for people who live there. They're going to pay anywhere from $30,000 to $100,000 a year membership fee to be able to ski there, privately.
Yeah.
All right, finally, a sad update on Elton John. The musician revealed that he was not able to see the performance of his new West End musical, The Devil Wears Prada, because he lost his eyesight. But he did say he's been enjoying listening to the show. He wrote the music, Romaine, for the stage adaptation of the movie, which opened at the Dominion Theater back in October.
Yeah, kind of sad. I actually had a impromptu chance to actually see him last Christmas season. He was performing outside of Saks Fifth Avenue here in New York City, and I just literally happened to brush by him. I have no idea where his security was or how I got so close to him, but definitely one of those great moments that you never forget. I do want to, before we go, I think we have to take a moment, a lot of moments really, to note the passing of Art Cashin. Of course, he was a frequent host, frequent appearance on TV. You go all the way back to his days at Payne Weber back in the 1980s. And there was a great podcast I heard of him where he talked about his origin story and how after Black Friday, everybody was just looking for somebody who could comment on what was going on. And there was really no one else around. He was just kind of this young trader. They grabbed him on the Financial News Network, which of course became CNBC.
Right.
And he was so great. And of course, he became a fixture on CNBC. He's appeared, of course, on Bloomberg as well. But there was a gravitas and a humility and a humor and a kindness with him that I think just really enraptured everyone on Wall Street.
Yeah, and he did it in a way where it didn't inspire panic, right? He spoke to people where they were as opposed to using a lot of jargon and making it confusing.
Yeah, and we did learn that he did pass away at the age of 83. Of course, he had that newsletter that was kind of a must-read, that had the brain teasers at the end. A big loss for Wall Street. Art Cashin, gone at 83. The holiday shopping season is here in full swing, and our next guest says shoppers are buying more items per transaction than they did last year. For more on what consumer trends he's seen, who better to talk to you than Stephen Yalof? He's the CEO over at Tanger. The company owns and operates 38 outlet centers across the U.S. and Canada. So you know better than anyone, Stephen, what people are doing and what people are buying. What type of traffic did you see over the course of the weekend?
Yeah, we were really thrilled with the traffic over the weekend. It started out pretty strong going into the weekend. Friday built on Saturday, and Sunday was strong too. Lines outside of stores, and as you know, in the outlet business, it's value every day, and Black Friday has become synonymous with value shopping.
Well, that's what I'm curious about. I mean, the outlet stores, of course, are offering discounts year-round here. Do those discounts are they higher during this type of season, or are they just kind of the same?
Well, I think the retailers have an opportunity to flex the discount during the course of the year, but during Black Friday, in a time where they know they're going after a particular customer, that's when they're offering their best deals. And, we were walking stores as early as late October, early November, and we were watching the buildup of staffing, the buildup of traffic. And as the holiday decor was coming out, the retailers were getting ready for what they anticipated to be one of their best Black Fridays ever.
Stephen, I'm curious as well whether there's a new wrinkle here this year in that a lot of people anticipate tariffs to be put on imported goods. To what extent are retailers using that possibility of tariffs to try to get more consumers to come in and make those big purchases before potentially the prices go up?
Well, I've spoken to a number of retailers, and definitely it's a concern. But I think what they tried to do was make sure that there was plenty of product and inventory in all of the stores. In fact, a few weeks ago, as I said, as I was walking shopping centers, boxes and boxes of inventory, even in some cases occupying storefront windows, because they really needed a place to keep the product. Anticipating a big holiday shopping season as they did, I think the retailers are saying now's a good time for the customer to buy, get in early, buy the things you want while we have them in stock, and we'll make sure we do our part, that we have the stores will be well inventoried and the value will definitely be there for you.
And of course, it's not just the products that are on hand at the stores themselves. It's all about the experience that you offer consumers who do make their way to your outlets. What are you doing differently this year than in years past?
Yeah, I think we've done a much better job with food. I think we've done a much better job of working with the retailers to make sure that not only are they staffing the store, but they have sales help on the floor. I think one of the major differentiators between shopping at home and shopping in store is the experience that you have in store. And so when there's sales help, when there's people that you can ask questions to, when you know that you're working with somebody inside the store who can be helpful, I think that really elevates the experience for the customer. And now, as I said, there's always lines outside in front of stores, particularly during this holiday shopping season. So the things that we're doing as a company is how can we surprise and delight our customers when they're standing online to make the waiting time just a little bit more fun for them as well.
I am curious, though, about the balance between the in-person shopping and obviously a lot of the online sales. We're getting preliminary numbers already, and there's certainly, obviously, a much bigger tilt towards just buying at home and getting things delivered. For outlet malls like the ones that you own, where do you find that balance of making sure that, well, I guess people can get things however they want it, and it's not at the expense of your own revenue?
Yeah, first of all, I think a lot of the online shopping is commodity driven. I think that if you're looking to buy the products, particularly what's in the stores right now, is mostly fashion apparel, fashion footwear, athletic apparel. And I think a lot of people are looking to try things on, hold things up. And I think the part that you're also missing is the fact that people like to shop in groups. What we saw this holiday season, and particularly this weekend, was people were shopping in large groups. They were shopping with their families. So it's more than just the shopping journey. It's the experience. It's the fun. It's the fact that you can do it in a big group and really, have fun doing it.
Yeah, and that's certainly so. I mean, I'm not a store person, Stephen, but I spent most of the weekend out at brick and mortar stores because my mother and the rest of my family were here, and that's what they wanted to do. And you're right, it was an experience. I don't know if we bought a lot, but we certainly had fun. I am curious, though, about how you prepare yourself for the post-holiday season. There's been a lot of talk about the new administration coming in the U.S. and the impact that tariffs could potentially have on the retail industry and inventories.
Well, look, I think, first of all, after the holiday season, once you get into January, the February months, which are typically the slowest, retail sales season, for us, most of our shopping centers are in the Southeast. And that's when a lot of folks will go to their vacation homes or leave cities and go to their second location. A lot of people take vacation in January and February, and we really meet the customer where they are. So in a number of our centers, the selling continues way into the first quarter of next year.
Good point. Well, we know the Southeast has seen a population explosion, and with it, probably a lot more foreign tourists as well. And, these foreign tourists who come over to the U.S. don't have the luxury of being able to leverage the omni-channel offerings. If they don't see it in the store, they can then order it on their phone. That option is closed off to them. And they're the ones who are buying, the Rolly suitcase and trying to put as much in there as they can before they leave for the day. What does that traffic look like going forward from here? I know we have this compressed holiday shopping season right now.
Well, that's right. And, I think that's another reason why retailers are so prepared and why the advertising is, it's so ubiquitous. It's because that customer, they want the customer out. They want the customer shopping. They want the customer out in their stores. And, you were talking earlier, Romaine, about, going there with your family and maybe you weren't shopping yourself. But if we're doing our job right, we're providing plenty of things for the person who doesn't want to shop to do. Whether it's better food and beverage, it's sit-down restaurants, a place to watch a game, or experiential uses like, a Dave & Buster's or things for you to do with the family. So when the people who are shopping shop, the people who are also on that shopping trip have something to do as well. And that's been a big pivot for us.
And just, Stephen, what we need? More chairs, more comfy chairs, so that when I walk in and my mother sees something that I know is going to take 30 minutes for her to look at, that I can just sit down and be comfortable.
We don't want you sitting, Romaine. We want you out there shopping in the stores.
All right, Stephen, appreciate your joining us today. Stephen Yalof is CEO of Tanger. Happy holidays to you. And of course, he's going to be pretty busy over the next couple of weeks with the holiday shopping season compressed into these next few weeks. Let's just give you a recap of how markets closed on the day. It was another record day for U.S. stocks with the S&P 500. I believe it's the 54th record close this year, but I know Alex is one who's keeping official tabs on that. A lot of catalysts to go through this week. Later this week, right? We have eco data like ISM services and the jobs report, and of course, Jay Powell speaking on Wednesday.
Yeah, Jay Powell speaking on Wednesday, and we still get, believe it or not, some consequential earnings. More retailers reporting, a big one in the tech sector with Salesforce as well. So some potential market-moving catalysts.
Yeah, and there's a pause in the U.S. Treasury rally. You see yields moving up. A lot of bond offerings, corporate bond offerings, may be stealing some of the shine. And the euro remains under pressure versus the dollar. The budget dispute in France threatens to bring down that government, possibly as early as this week.
All right, you're looking at an S&P 500 still sitting on that record high, 6,047. When we turn back to the big show here in just a second, we're going to take a look back in history and the day that the lights went out on Enron. And here's a question for you before we go to break. Enron was the biggest corporate bankruptcy based on assets at the time of its filing in 2001, though that has been eclipsed by at least 5 other companies since. Can you name at least 3 of those 5 companies, Scarlett? I'll let you think on that.
All right.
This is The Close on Bloomberg. All right, time now for a look back at this day in history, December 2nd, 2001. That was the day Enron Corp filed for what at the time was the largest ever corporate bankruptcy. Now, it was a filing that came with a warning that a substantial number of Enron's 21,000 employees would be out of a job as the company's market value plummeted amid multiple investigations into allegations of accounting fraud. It was a stunning fall from grace for a company formed through a merger back in 1985 and built up through dozens of subsequent mergers to become not only the world's largest energy trader, but the world's 7th largest company overall. At its peak in the year 2000, Enron was officially pulling in more revenue than IBM, Disney, and Bank of America combined. By the time it filed for Chapter 11 protection in 2001, though, its shares were worth pennies. And almost 5 years of earnings had to be restated, exposing a company that was, well, not as flush and financially sound as investors had thought. That included more than $1 billion of write-offs for failed investments in water companies, in broadband trading, and retail electricity sales. It also included a $1.2 billion loss in shareholder equity because of dealings with affiliated partnerships. Now, a rescue buyout plan by rival energy trader Dynegy, it was scrapped 2.5 weeks after it was announced because of concern Enron still hadn't disclosed all of its liabilities. So a few days after that, Enron sought bankruptcy protection, listing roughly $50 billion in assets, making it the biggest Chapter 11 filing based on that metric. Now, that title, though, has been ceded to at least 5 other companies since. Can you name at least 3 of those companies? Well, here they are in ascending order. CIT, General Motors, WorldCom, Washington Mutual, and Liebmann Brothers. Each had filings that did eclipse Enron. Still, Enron's legacy is just as notable, if not more so. That's because Enron, a name once synonymous with corporate savvy, is now basically a punchline, a synonym for corporate deceit and greed. And in the wake of Enron's meltdown, government prosecutors were emboldened to go after several other major companies for their accounting practices as well, targeting the founders, CEOs, and executives at WorldCom, at HealthSouth, Adelphia Communications, and Rite Aid, among others.
Yeah, very well said. Enron feels like it's become shorthand for corporate malfeasance, whether that's fair or not. That's kind of how it's evolved in popular culture. All right, let's switch gears now and focus on foreign policy. It is day 2 of President Biden's trip to Central Africa, and he is visiting Angola to meet with its president, along with traveling to meet the leader of Zambia. This is part of Biden's agenda to promote U.S. investment in trade and infrastructure on that continent. Joining us now for more on this and a check on the latest political developments is John Lieber. He is managing director and head of research at Eurasia Group. John, good to speak with you. Walk us through why Biden is making this trip now. He's a lame duck. All the headlines are coming out of Mar-a-Lago rather than Washington, let alone Central Africa, when it comes to what the U.S. administration is doing. What is the U.S.'s long-term strategy in Africa, especially as it relates to countering the influence of China?
Well, Africa is typically a bit of an afterthought in U.S. foreign policy, but the fact that there's such a global struggle for dominance in critical minerals right now, and the fact that Central Africa is the home of massive amounts of critical mineral resources, lithium and copper and cobalt and others, makes it a strategically important place for the United States to be investing over the next decade or so. And this has been a theme throughout the Biden administration, but also through the Trump administration, who marshaled significant resources into the Development Finance Corporation in order to help African countries and foreign companies build out the infrastructure that they need to get the critical minerals to the coasts and then out to for processing elsewhere in the globe. And that struggle is going to continue. That story is going to continue. China's had a very active presence with its Belt and Road Initiative in Africa. Biden made a promise in order to go to the country, and he can now claim that he's traveled all over the globe and visited every continent before he leaves his office.
So thank you for explaining that through line from the first Trump administration to Biden. What would success for Biden look like in that he would be creating or building on something that the incoming Trump administration would further develop?
Yeah, I mean, I think a successful legacy here would be something that the Trump administration could continue. Investments in the Lobito corridor, in the export infrastructure in Angola, would be something that would be a legacy that would last for years, that could tilt the balance of power in Africa back towards the United States. And if you think about this influence game with China, it's something that he's setting up Donald Trump to succeed in. And I think that's what's at stake here, and that's why President Biden's trying to deliver this on the way out the door. Now, of course, this trip was set up before the election, so he had no idea that he'd be handing over this to Donald Trump, or if he'd be handing it to Kamala Harris. Turns out it was Trump. But in this long-term competition with China, it's something that both parties in Washington agree on, and it's going to be an important piece of both presidents' legacy.
It's something that definitely both parties agree on. It's also something that both parties have been grossly negligent on as well. And anyone who's gone through Africa, particularly in Western Africa, and even in some of the places in southern parts of that continent, the influence of China is enormous. They own a lot of stuff, John. I don't understand how the U.S. catches up with that in short order, because this isn't just about dangling a couple of incentives here or there. They need billions, multiple billions of dollars of investments to do what China has been doing for the last 25 years.
Yeah, I don't think the U.S. has a chance or even a hope of catching up with China. I mean, China has been overextending itself with a massive debt bubble for years now. And that's not something, I mean, the U.S. does that in its own way, of course, but they're not doing it in order to make big investments in Africa. China's been much more strategic about its alliances and how it tries to build and buy friends around the globe, whereas the U.S. is prone to a much more expansive foreign policy that puts a lot of focus on a smaller number of areas, and Africa has traditionally not been one of those. It's been an area that the U.S. has neglected. However, there are trade benefits for a lot of Southern African countries that are going to be up for renewal in the Trump administration, and there will, I think, be more focus on this going forward because of the neglect you're talking about where China's been stepping into.
All right, John, I do want to pivot back to the president-elect, of course, because he will be in charge starting on January 20th. He's been pretty active here in laying out cabinet positions as well as other key advisory roles. We just got a readout from a meeting that Pam Bondi, the nominee to be Attorney General, she had to sit down with Senator Grassley, who is effectively going to be in charge of ushering her nomination through the Senate. She, of all the picks that Trump has made, I mean, she probably seems like the one that will sail through Senate confirmation the easiest, certainly compared to the picks for like FBI, for, I don't know, Health and Human Services, et cetera, et cetera.
Yeah, I would expect that a Republican Senate is overwhelmingly likely to confirm most of the nominees from a Republican president, and that includes Pam Bondi. She's clearly qualified. Obviously, she's controversial because she's being picked for her loyalty to President Trump. RFK Jr., I would think he gets confirmed as well. You're hearing senators make a lot of positive comments about him, and he's already changing some of the dialogue about U.S. Health and safety regulations when it comes to food. There will be a massive lobbying effort against this guy, but I think that the president's chosen him and Republicans are going to want to confirm him. There will be exceptions, of course. You already saw Matt Gaetz had to withdraw his nomination. And I think Kash Patel is going to have a very difficult time becoming the U.S.'s top law enforcement officer at the FBI. He's just not qualified, and Republicans know it. That would really surprise me to see him be confirmed.
There was a lot of talk that perhaps there would be recess appointments for some of these cabinet positions, particularly some of the more controversial nominations. Do you still see that happening here, John?
In order to do recess appointments, you have to have the Senate go into recess. And to go into recess, you need the House, the Senate to agree to that, which means you need Democrats and Republicans to agree. It's possible the president could force a recess under his constitutional powers, but you would need somebody, probably Speaker Mike Johnson, in Congress to cooperate with that. So I think recess appointments are unlikely right now. Trump's going to get 99% of the people that he nominates confirmed. They would be unnecessary given the current alignment in the Senate and their inclination to confirm most of his picks. So I don't see this happening, but with Trump, you never know. Norms have been falling by the day, even during the 3 weeks of this transition so far, and that could be the next norm to fall next year.
Yeah, you never know, but we have the playbook from 8 years ago to kind of follow and to lay out what we might expect. And of course, that includes a lot of threats made on social media, whether it's tariffs on our North American neighbors or on China, and most recently on BRICS countries, encouraging them that they should stick with the U.S. dollar-based currency system and not explore alternative currencies. How do you see this potentially backfiring, John?
This threat, the problem with Trump is that he says a lot of things and you don't know what he's actually going to end up doing. So it could be the case that countries just get used to these threats and stop making anything of them. And that, the 100% tariffs on BRICS-aligned countries never materialize and everybody moves on. And the next threat he makes, everybody basically ignores. So I think that's the threat of it backfiring on him. However, I do think that some of these threats are going to materialize. I think that China should be very worried about the 10% tariff that Trump truthed about last week. Mexico and Canada seem to be doing the things that they need to do to avoid the 25% tariff he threatened. And then the latest threat came today for unknown actors in the Middle East who need to release the Israeli hostages lest they face some kind of retribution from the United States. We don't know who he's talking about or what level of retribution he's talking about, but these threats are going to be a dominant tool of foreign policy, and the president has the power to enact them if he chooses to. And I think that we won't know yet for another month and a half until he's inaugurated which ones of them materialize and which ones won't.
All right. And of course, getting new headlines now. Trump nominating Warren Stevens to be ambassador to the UK. John, I'm going to have to let you go. John Lieber, managing director and head of research over at the Eurasia Group.
We also have some other breaking news from Delaware. The judge there has once again rejected the pay package for Elon Musk, that record-setting pay package that the shareholders had approved back in June. She is now reaffirming her earlier ruling, voiding that compensation. And Romaine, that compensation goes all the way back to 2018. So this sets up yet another dispute, a possible appeal as well.
Yeah, and this was a wild pay package. We're talking about something that I think when it was first proposed, it was like a couple $2 billion. And then because of the share price rise, it got up to something like $56 billion. And it raised a lot of questions. Even with the contributions he's making to the company, should you be paying a CEO that much money? Of course, this is in the courts. It's not settled, but another lawsuit here on that front for Elon Musk.
All right, and you see Tesla shares moving down in after hours trading by about 1%. Still ahead, we've got what investors need to watch for tomorrow. This is Bloomberg.
Pushing ahead to what markets will have their eye on over the next 24 hours. It starts at 10 a.m. with those job opening data.
Yeah, JOLTS comes out at 10 a.m., but it's for the month of October, so it's a little bit backwards looking. Nonetheless, part of the drumbeat to the non-farm payrolls report on Friday.
We're going to hear from Gary Gensler, believe it or not, at 3 p.m. tomorrow. Definitely want to hear what he has to say. Of course, probably the outgoing commissioner of the SEC. And we do get Fed Speak tomorrow.
We get Fed Speak. Kugler and Goolsbee will be speaking, but the main event is, of course, Powell on Wednesday.
We also get some earnings as well, including from 3 consequential tech companies, Okta, Marvell, and Salesforce. I was looking at Salesforce revenue growth projections, 7% in the quarter. It's going to be the slowest revenue growth they've had as a public company.
All right, that does it for us.
All right, stick around. Balance of Power coming up next. This is Bloomberg.